The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He is my good buddy, Andreas Steno Larsen, and he is a senior editor at Real Vision. Did I get that right, buddy?
Correct, George.
All right. we don't want to piss off our good friend Raul Paul.
No, exactly.
No, Raul's awesome. I love what you guys do at Real Vision. And I also love what you're doing with Macro Alf and the podcast that you have there. And I can just between you and I and about 100,000 other people, I love the Real Vision podcast, but I like it even better when you host it. So like when I go through my feed on my phone, I always look to see if you're hosting it. And then I'm like, oh, I'm going to listen to that one for sure.
You're too kind, George.
All right, man. So let's dive into this here. The first thing I wanted to discuss is a rather esoteric item that I've really only heard Snyder talk about. And that's the inversion of the Eurodollar future curve.
Yeah.
And I heard you talk about that the other day. So I wanted to get your view on, is this something we should be looking at? What are the predictive abilities? Or is it just something that's kind of noise?
Well, if you look at history, this is basically one of the best signals that we have in financial markets in terms of what's upcoming when it comes to growth. So when you look at the shape of the Eurodollar futures curve, it actually tells you something about the future often. So right now we have an inverted curve, which basically means that the market expects the dollar LIBOR interest rate to go up initially over the next, say, 3, 4, 5 months. And then the market expects that same dollar LIBOR interest rate to drop back again during the early parts of the spring next year, and basically throughout the remainder of 2023. So what that tells you is, first of all, that the market expects the Federal Reserve to turn around, to pivot, basically. But secondly, it also tells you something about the market's view on liquidity in dollars over the coming 3, 4, 5 quarters.
Right.
Because usually what happens when the dollar curve, the euro dollar curve inverts, is that we see a higher potential or higher risk for a so-called liquidity event upcoming. And I think we have the early warning signals across the board in terms of dollar liquidity again. If you look at liquidity in bond markets, it's looking absolutely mediocre already. If you look at liquidity across other asset classes, we already see the early warning signals as well. And the Eurodollar curve is basically the first curve that tells you so.
What would be a good example of a liquidity event?
Well, if you look at so-called repo markets, we have weekly statistics from all of the primary dealers of US Treasuries. Right. And when there is a rise in the amount of fails to deliver in terms of bonds that you've used as the collateral in repurchase agreements, then I would consider that a firm liquidity event. And right now we have a rising amount of fails to deliver week after week in these primary dealer statistics. So that is, to me, an early warning signal that we actually already have a liquidity event. The ultimate end game of a liquidity event is what I call a dash for dollar cash. We saw such a move right after the early lockdowns in March 2020. Basically, right about every asset class sold off except for dollar cash, right? And that's, I guess, the ultimate risk scenario again here, that we end up in a dash for cash scenario and then the Fed will pivot.
Yeah, you were even talking about that with Groman. And even Groman, who is notoriously a dollar bear, said that if the Fed continues to raise rates, I think he used the term weaponizing, the Treasury weaponizing the Fed, that the only thing that you'd want to own are dollars. And this is from a long-term bear for sure.
Yeah. It's basically one of the few things that I want to own right now. I've been long dollar for quite a while. I'm born and raised in Europe, so I mean I can even gain from it versus the euro, right? So right now I mean, it's the only light that I have at the end of the tunnel because I earn a lot of my income in dollars and I pay my bills in euros. So that's a pretty decent hedge against what's going on.
Let's drill down on that a little bit further, because people, especially Americans, they always ask the question, well, who on earth would buy a treasury right now? Like, who in their right mind would get paid 3% to own a 10-year when the rate of CPI, as the government admits to, is 9.1%. And I'm like, okay, that's one view, but you also have to look at it from the standpoint of people whose expenses are not denominated in dollars, whose expenses are denominated in yen or in euros, or in my case right now, in Colombian pesos. And for those people, they don't really care about the CPI in the United States, because that's just your purchasing power. So I guess my question would be, when you're setting up your own portfolio, do you care about the CPI in the United States, or to what degree do you care about it, and why?
I only care about it because it matters for the Federal Reserve outlook, but otherwise it doesn't really matter to me. So you're absolutely right that foreign buyers of US Treasuries, they don't necessarily care too much about the level of the CPI. They care about the Fed outlook. And I mean, it's been pretty visible that the Fed is not super serious about inflation, right? Even though we have inflation running at almost double-digit growth rates, they only like partially react to it. I mean, that's been my base case throughout this year. I've been wrong about the level of inflation that we would reach, but I kept saying that they would not make a big move in the direction of higher nominal interest rates. I mean, they've made a move, but we're back to like square one before COVID, and we have a completely different scenario for inflation, right? So the base case has been, from my side, all the way through this, that real interest rates will remain negative. I think it's the only way to get us out of this debt mess that we're in the midst of. And therefore, that is basically the equation I need to look at when buying a treasury from abroad. If the Federal Reserve only reacts partially to inflation, then it could be a good buy, even from such an equation seen from abroad.
Right. So I've heard you talk about being in kind of the disinflation camp, and correct me if I'm wrong there. So it's just, you believe that we're going to continue to see prices increase, but just at lower levels, because potentially we're going, or there's a high probability that we're going into an economic recession in the United States, and that's going to reduce aggregate demand, increase unemployment, and to a certain degree there, we just give a hat tip to the Phillips curve. Although that's deeply flawed, I see that maybe playing out here. And in fact, I read an article this morning on how we're seeing a lot of older folks get back into the labor force that retired early because assets were way up here, but now all of a sudden that assets are down here. It's time to go back to work. And so we could see a labor shortage go to a labor surplus very quickly. But bottom line there, aggregate demand comes down, which brings down the rate of inflation, even though we still have a supply side problem. So what time frame do you see that playing out? And what do you think the Fed, and maybe more importantly, the government's response to that would be?
Well, I think the main argument behind the disinflation view is based on what's going on in China. We have basically what I will call bank runs unfolding right as we speak in China. We have a public uprising against mortgage payments on home building projects that are not finished, and all of it is on top of a bizarre zero COVID policy that's still ongoing, right? So if you look beneath the surface of the Chinese economy right now, then I think the reality is extremely dark. And I think that's the main reason why we've seen this setback in right about every commodity linked to the otherwise booming real estate sector in China. Copper is down materially. I think it's in the clear bear market, that particular metal. We've seen a setback for the oil price. Even the natural gas price is lower across the globe compared to peaks. So China is the main reason. The second reason is that the Federal Reserve I think has done enough to bring the US into a recession. That's also what the Eurodollar futures curve is telling us. The recession is probably not unfolding today, but it may be unfolding in, say, a quarter or two from now. And we know that at least commodity markets tend to be forward-looking when it comes to recessions. So I think from like very physical goods, from that side of the equation on inflation, I basically expect deflation next year because year-over-year growth will be negative. The question is whether service prices will follow. I guess the audience in the US will know that the shelter costs or the rent of shelter has absolutely exploded this year. It's not fully reflected in the CPI yet. I expect it to be fully reflected with a time lag because that's usually what happens. So that component will stay very sticky over the course of the autumn and into next year.
Which is 35% or 33% of the total.
Yeah. But the goods inflation, that's coming down, and it's coming down hard. And that's basically the main argument behind my disinflation view now.
Okay. So and I'd like to add to that and maybe get your thoughts on it, that the Treasury curve also inverted, which most of my viewers know. But as of yesterday, the day prior, it inverted all the way, I guess, back, you would say, to the 6-month maturity. So the 6-month had a higher yield than the 10-year Treasury. And so I'm assuming that if an inversion with the 2s and 10s is bad, an inversion of the 6-month and the 10-year is even worse.
Yeah. And I mean, the Federal Reserve, they run a model looking at the 3-month point versus the 10-year point. So I guess when the 3-month point is higher than the 10-year point, that could be sort of a good timing to expect the Fed to become a little bit nervous about the yield curve structure.
Yeah, absolutely. In fact, I'm not really, I'm someone, if I were to hold a Treasury, I would not want to hold one for 10 years. And that's my reason for holding it, is just to get the yield and have a positive return above and beyond inflation, because I don't think that's what's going to happen here. But I actually, in my own portfolio, and I've discussed this on the channel a couple of times, I actually took some of the dry powder and bought 1-year Treasuries. Because longer term, I'm pretty bullish on commodities, just going into a long-term super cycle. But they're very, very volatile. They don't go up in a straight line. So I think if we go into a recession, there could be a buying opportunity, in which case the interest rates are most likely lower. So you could get kind of a double whammy where you get a pop on your dry powder from holding it in 1-year Treasuries. So you sell early, you get the capital gain, and you parlay that into commodities. In worst case scenario, you just let them mature and collect a 3% where you'd get, 1% or whatever in a bank account.
I think that sounds like a super decent strategy. It was essentially kind of the same argument I made seen from a European standpoint, that as long as the Fed doesn't completely out hike expectations, then you're pretty good off buying a few short running bonds, maybe even 5 to 10 year bonds, and hold them for a short time span. I don't think you should hold them to maturity. I perfectly agree with that, because that will be a crappy deal if you look at it in 10 years time from now. But it may make sense with the 6, 9, 12 months horizon, as a way of reflecting the scenario that is right in front of us, with very weak growth, if not negative, and rising unemployment.
What do you think? And this is another thing I've heard Snyder talk about recently with Emil. What do you think about the fact that the 4-week yield is so far under reverse repo? So just for the viewers, theoretically, the Fed would like you to believe that the absolute lowest interest rate available would be reverse repo. So if you've got an entity out there that has excess cash and the Fed wants the interest rates through IOR to be at a certain level, well, they'll have a few basis points under that, where if you're not a bank that has an account with the Fed, let's say, and you want to lend cash, you're not going to lend it at a lower rate than you could get through reverse repo, because why would you do that when it's completely risk-free and you're getting collateral in the form of, let's say, a T-bill or something, which is highly valuable. But then the 4-week treasuries themselves are trading at a premium or a much lower interest rate. And this would imply that there's that these entities would far rather have the treasuries than have their cash, quote unquote, parked at the Fed, implying that there's some sort of utilization in their balance sheet where those T-bills are superior just to having the quote unquote cash. Well, have you thought through that? And if you have, what does the fact that those T-bills are trading so much lower than reverse repo, what does that tell you?
To me, it's a clear signal that there's sort of a scarcity of collateral. We need to remember that quite a few players in the financial markets, they don't have access directly to the Federal Reserve. So the T-bill is the best high quality collateral you can have in private repurchase agreements. And I basically think that we have too few T-bills right now compared to the demand for T-bills. And that's kind of the simple explanation why it could trade below the floor that the Federal Reserve sets. Because there are players out there without access directly to that reverse repo rate. And therefore you can get T-bills trading through that bottom.
Yeah, which begs the next question is, if there's a shortage in collateral, what type of risk may that imply throughout the financial system itself?
Well, we've seen it before, haven't we? I mean, when there is a shortage of collateral, it's usually an early warning signal that there is a shortage of liquidity upcoming. And we had the best example of it, I think it was in September 2019, wasn't it, when the Federal Reserve had to restart some kind of quasi QE program as a consequence of a lack of liquidity in the system.
Yeah, and where they screwed up and bought T-bills, by the way.
Yes.
The exact thing that the system needed.
Exactly. So they actually made matters worse over time. And I guess it's a bit of a guessing game at which point the same kind of scarcity will kick in this time around. But it's certainly something that we will need to be on the watch for, because that level of liquidity has increased since the last liquidity crisis. It always does, because of more debt in the system, etc.
Or the need for liquidity is what you're saying.
Yes. Yes. So, I mean, the liquidity level needs to rise year after year, given the credit system that we've created. And therefore, I don't know the exact number, but it's certainly higher than the Federal Reserve thinks.
Yeah. And this, I think that the repo fails are pretty much saying the exact same thing that delta between the 4-week yield and reverse repo is saying. Because just to explain to the audience, if you and I are involved in a repo transaction, basically I'm lending you $1 billion, you're giving me T-bills in the amount of $1 billion, and we switch back the next day, and then the borrower pays a bit of interest there. But if a repo fails, basically you and I have an agreement, but then when we go to actually settle the initial transaction, one of us backs out of the deal and says, no, I'm not doing that. And correct me if I'm wrong, but usually the lender would back out of the deal because either there's a little bit more counterparty risk than they thought, or the collateral which they were going to receive, there's something a little suspicious about it, like maybe it's been rehypothecated 20 times instead of 3 times or something like that. Am I getting that right?
Yeah, absolutely. So, I mean, the amount of times the same collateral is sort of securitized, the worse in this sense, right? So you're absolutely spot on.
Yeah. So again, guys who are watching, just the takeaway here is that when you're seeing these repo fails increase, that is a sign, most likely, that there's more counterparty risk. It's also a sign that the collateral multiplier is actually decreasing. And this, coupled with what we're seeing with the 4-week T-bill rate in reverse repo, would lead one to believe that, like Andreas was saying, that the level of liquidity needs that we have right now due to what has happened over the last 2 years are not being met. And that creates potentially systemic risk within the system.
Absolutely.
All right, so now let's move on to the dollar. I mean, it shot up, 106 is up to 109 the other day. I did a couple videos just kind of based on Brent's ideas, with the dollar milkshake there, and how this could be very detrimental to especially emerging markets that have a high degree of their debt denominated in dollars. What's your view on what's happening with the dollar right now, and why is that a problem for a lot of these economies? And maybe it becomes a problem for Europe and Japan.
Well, I mean, first of all, I don't even think that we've seen the milkshake theory unfolding yet. I think it will unfold during the autumn, but we haven't seen it yet. When this liquidity event kicks in, then that's the timing to expect the milkshake theory to unfold itself. So I'm still positive on the dollar versus a bunch of other currencies, basically. If we look at the reason why the dollar is strong by now, I think it's mostly an energy question. As you can see, I'm sweating like a pig here because it's extremely hot in Europe these days, and we don't have any air condition at all because we're not used to this kind of these kind of temperatures. But point being that if we look at the energy situation right now, the US is basically the only country, more or less, in the Western world with a decent local energy balance. The US is not in need of importing a lot of energy. Europe is in need of importing a lot of energy. Japan needs to import a lot of energy. I mean, I live just north of Germany, and I think essentially Germany is able to meet like 10 to 15% of its own energy demands. So it's right about nothing, right? And therefore we see currently a massive spread between the price of natural gas, in particular between the price in Europe and the price in the US. The reason being that the Europeans need to pay up for liquid natural gas to fill up storages ahead of the winter due to the lack of flow from Russia. I know they reopened the Nord Stream pipeline from Russia to Europe today, but it's still running at low levels compared to what's normal. So we need to take that into account. So if you look at the spread between nat gas traded in Europe and nat gas traded in the US, you have the best driver of euro versus dollar. I think that's basically been the main driver.
And so that's the driver in the DXY.
Yeah. By the end of the day, yes.
Right, because the euro is 57% of that. Yeah. But we've also seen the yen outside of the DXY question. We've seen the yen just really plummet. I know even here in Colombia, when I first got back a few months ago, but this was before Petro, the quasi-socialist guy, won the election here. The peso was trading about 3,800, and now it's maybe 4,400, something like that. So my point there is, I think a lot of currencies, even outside of that DXY basket, have been going down against the dollar, which I guess maybe is that a flight to safety because of the global markets sniffing out potentially a global recession?
Yeah, I think that's a fair assessment. To me, the broad dollar index is sort of a harbinger of global financial conditions. So this is ultimately how you should look at the dollar. If the dollar strengthens a lot, it is a signal that global growth is deteriorating fast. We see that correlation across the time series, basically. And if you look 20, 30 years back, that correlation is pretty strong. So the dollar usually strengthens ahead of the global recession, yes.
I want to go back to the yield curve really quick and get your opinion on this, because about 4 or 5 months ago, when the curve first inverted, the 2s and 10s, I heard a lot of chatter on Twitter, people saying that it doesn't matter, because the Fed has so much control over the long end that you really can't make any type of judgment based on the 10-year Treasury yield. And to me, that really didn't make a lot of sense, because every time the Fed does quantitative easing to quote unquote lower rates, the long end goes up. And every time, the one time they did a quantitative tightening to a certain extent, interest rates actually went down. So I don't know, maybe you could have said that they would have gone up even more without the QE, but I think that's kind of a tough argument there. And, even so, prior to COVID, we had an inversion. I think even prior to the repo blow up in September 2019, we had an inversion. And, maybe it was just coincidental that we got a huge recession. I don't know. But I think the economy was kind of primed for that. But what's your take on the view? And I don't hear it too often anymore because we just see recession signs everywhere. But what's your take on how much impact the Fed has on the predictive ability or the signals from the long end of the curve?
Well, yeah, I guess you almost sound like an academic member of one of the reserve banks when you say that the ability to predict recessions is weaker than it was before QE was invented, because that's a typical central bank argument. I sincerely think that the yield curve is still telling the truth. If you look at the amount or the percentage of the far end of the yield curve in the control of the Fed, I think we are running at right about, say, 35 to 37% of the far end of the yield curve being at the Fed's balance sheet. So I still think that it's a fairly free market. It's not, of course, not a perfectly free market, but it's close to being one. Of course, if you look at the Japanese yield curve, that yield curve is not telling you anything at all because they control it all. But the Fed doesn't control the yield curve in the US to any majority extent, at least. So, of course, could the signal be distorted a little bit? Yeah, why not? But the signal is still valid to a large extent. And the reason why I think that interest rates go up when the Fed conducts QE is, first of all, that most of the effect is priced in already when they signal that they will start buying.
Right.
That's one thing. The second thing is that, very mechanically speaking, when the Federal Reserve starts buying sort of the inner portion of the risk curve, if we have the Treasury bond at the very inner part of the risk curve, and you have a high yield bond in Botswana and Africa on the very far end of the risk curve, what you basically do when you conduct QE is that you push private investors outwards on the risk curve, while the Federal Reserve takes a portion of the inner part of the risk curve. I think that's the reason why you see interest rates moving up ultimately, because investors are seeking outwards. They want more risk. They're not buying the inner part of the risk curve because they know they're kind of bailed out by the Fed during such a period.
Right.
While in the opposite scenario with QT, the Fed leaves a part of this inner part of the risk curve up for grabs, and thereby slowly but surely they pull investors inwards because someone has to buy these bonds, leaving other asset classes more vulnerable to QT than the bond market.
That makes a lot of sense. On that note, I'd love to get your opinion on why or why not QE is inflationary. Because, you hear this so often that quantitative easing is they're pumping liquidity into the system. And I always have a hard time with that because I'm like, and I try to think through the whole process, and maybe I'm getting too far into the weeds. But I'm like, okay, let's just start here with the Fed is buying a Treasury. Who are they buying it from? Okay, probably a primary dealer. Got it. Okay, so how is that primary dealer paying for those Treasuries? Most likely bank reserves, because let's just assume it's a primary dealer within JP Morgan. And so it's just bank reserves going from JP Morgan's account down to the TGA, let's say. Okay, well, let's just say that primary dealer is buying from the average Joe, right? So if he's buying from the average Joe originally with the original transaction, then they're adding dollars into the quote unquote money supply. If you want to look at money or dollar supply as liabilities, deposit liabilities of commercial banks. Because you've got the average Joe balance sheet, which starts with the Treasury and then ends up with quote unquote dollars. So you've got that increasing there. And so I guess that would create an environment where there are more dollars than there were before. But then is that with the average Joe, or is that with a bank? And then what are they doing with it as far as those additional dollars? Are they then going further out the risk curve, to your point, and buying stocks or buying something in some other country, or are they buying goods and services that, where the dollars circulate with a bit of velocity, increasing the rate of inflation? So you see, and I know that I'm really getting into the weeds there, but I don't think it's really a cut and dry. Okay, if the Fed is doing QE, it's increasing liquidity, or if they're doing QT, it's reducing liquidity. When the banks have so much control over how many dollars are actually being produced.
I think you nailed it here. What matters in this discussion is the ultimate receiver of the deposit when the Federal Reserve creates new dollars. Because if the ultimate receiver of the deposit is a pension fund, then I don't think it's an inflationary, at least not from a CPI perspective.
Right.
It's inflationary in assets. But if the ultimate receiver of the deposit is a regular household, then it's inflationary. And I think that's been the game changer through 2020 and 2021, that we had monetary policy and fiscal policy working in tandem to ensure that newly printed dollars ended up at deposits among average households. That's why we have inflation now. And the reason why we had inflation in everything in 2020 and 2021, both assets, goods, services, whatever, is that both the Fed printed money, but also the government printed money via the deficit. So that's, I mean, to me, if I should put up very simple rules, if the Federal Reserve prints money, but ensures that those new dollars only ends up in pension funds, then you only see asset inflation. If the Federal Reserve cooperates with the Treasury to ensure that the money will actually reach the average household, then you should expect inflation in goods and services.
Yeah, very well said. But you said it much better than I did. At least you got my point. That's good. Yeah. So then I guess my next question would be, and I've tried to think this through, but if we go into a recession, you know, the common belief is that if inflation is still running hot, the Fed can't do QE because they're just going to exacerbate inflation. And that's an opinion I had, you know, last year, maybe prior to that, but I've kind of had to reevaluate that and said, well, wait a minute. I don't know. I mean, if inflation is at 5-6% and they just do QE alone, is there a 100% probability that inflation goes up to 9, 10, 12, 13? I don't think so. And then again, it depends on fiscal. So in my mind, the bigger question now, I think since COVID in 2020, is what's going on the fiscal side of the equation as opposed to what's going on the monetary side of the equation. Because it's almost like we've gone from a Fed put to a government put in a sense. You know, what do you think about that?
Well, I think you're spot on. If the Federal Reserve decides to print new dollars and buy assets, and by the end of the day, deposit some pension fund for the purchase of those assets, then I don't think that it will add to the inflation that we see right now, because that inflation is clearly linked to something going on in the real economy, right? And the point here is that a deposit at a pension fund holds almost zero velocity. It's not moving around a lot of times during the year, because a pension fund just buys another asset, and then there's a new deposit at
yeah, they're not buying hamburgers and Ford pickup trucks.
No, exactly. So I actually think that if we get very tight fiscal policy and QE at the same time into 2023, which I find fairly likely, then inflation, at least measured in CPI terms, would stay relatively contained.
So what do you think would be their game plan? Let's just fast forward to 2023. Assume that we're in a recession, that the government or whatever body, I think it's like 8 people that determine whether we're in a recession or something. Let's just assume they say, yep, we're in a recession and it's pretty severe. People are feeling the pain. We're seeing the unemployment rate go up, but we're seeing inflation tick down as far as the CPI. What do you think the Fed's response would be? What do you think the government's response would be? I mean, I'm assuming you're going to say interest rates down because that's what the Eurodollar futures curve is telling us. But do you think they go back to QE? You think they pause? Do you think they move forward with QT to try to maybe bring down asset prices while, I don't know, stimulating the economy? And then what do you think the government does? You know, is there too much conflict there for them to unroll? another CARES 2.0 package, or would it be politically palatable if the average Joe and Jane is still pissed off about consumer price inflation?
I mean, I think the Fed response will depend a lot on fiscal policy this time around, because if we enter a recession with a, say, 6 to 7% deficit of GDP, then we could easily imagine a deficit of 10 to 12% during a recession, right? Due to the very bad starting point. And if the Fed conducts QE while the deficit is at 10 to 12% of the gross domestic product, then we will have inflation again. So what matters now for the Federal Reserve is whether they are able to convince Janet Yellen to really tighten fiscal policy into next year, so that the starting point is much more benign seen from a fiscal perspective.
Meaning spend a lot less out of the TGA.
Yes, exactly. And I think that's a very feasible scenario. Janet Yellen sounds like a German at the moment, right? I mean, she's completely turned around on that agenda, I'd say, over the past 3-6 months, from wanting to spend right about every single dollar she could get a hold of, to now saying that they will need to contain themselves to a much larger extent. I think that's a pretty big game changer. So my ultimate base case for next year is that we will have fairly tight fiscal policy, but in a year from now, we will be debating QE, potentially even negative interest rates again, at least in Europe.
Yeah. All right. So on that bombshell, we'll kind of leave it there. Andreas, for my viewers and listeners who want to find out more about what you do, where can they go?
They can find me on Real Vision. They can find me on right about every podcast app. I host the Macro Trading Floor each and every Sunday. And then finally, they can find me on Twitter at Andreas Steno.
Awesome, buddy. I appreciate your time. Can't wait to do it again.
It was a pleasure, George. Thanks for having me.